Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments, and subscribers. I greatly appreciate it. This week up, Microsoft Corporation. We're going to go through their annual report. We're going to look at 9 years of historical financial. We're going to peel back the onion, figure out how much cash money does Microsoft generate. Then we're going to forecast the price and figure out how much we can earn by holding the stock today. Ready? Let's get to work. Before we begin with Microsoft, I want to go through the 5 key attributes that we use here at this channel to value all of our securities. Number 1, top line revenue growth. You got to have it. Number 2, EBITDA growth. EBITDA is the enterprise level earnings that we want to see it growing. Number 3 is strong cash flow. You must have positive, growing, strong margin free cash flow. Number 3, low debt. That's less than 3 times debt to EBITDA is what we need. And finally, we need a well-priced stock. We use enterprise value divided by EBITDA as a metric for well-priced, but it also needs to have a market-beating return in the IRR. We use those 5 key attributes when we assess all stocks, and we need those things to line up before we consider the investment at all. All right, let's get back to Microsoft. Okay, behind me is the most recent 10K for Microsoft. It's filed as of June 30, 2021. Their fiscal year ends in June, so all these numbers are going to be June 30 and prior. That represents their fiscal year. Now, I highly suggest that you go to Microsoft's website, go to the IR section, download this. It's got fantastic information. You can also download the annual report and read the chairman and CEO's letter. It's outstanding. Their performance has been very good. Let's see what the stock is worth. Okay, behind me is 9 years of historical financial information for Microsoft. You can see revenue in 2013 ending in June 2013, $77 billion, and that has grown consistently almost every year to $168 billion last year during a pandemic, an absolute monster number. Congratulations, Microsoft and team. Outstanding. That's a 10% kind of annualized CAGR over the 9 years for growing top line revenue at 10%, a strong curly number. I really like that. Great job, team. And that's one checkbox for us when we're doing company review. Now, the EBITDA for Microsoft in 2013 was $30 billion, and that has grown consistently over the last 9 years as well to a record $80 billion in 1 year on $168 billion of revenue. That is almost a 50% EBITDA margin. Outstanding. Good job, team. And that is growing at 13% annualized over that period of time, which again, slightly higher than revenue. So margins are growing as Microsoft gets bigger and bigger. I really like this. That's very clean. It's large and it's growing. Fantastic. That checks the 2 boxes for us. Let's go look at enterprise value. So when we look at enterprise value, we always begin with debt. Microsoft had $16.2 billion of debt in 2013, has grown to $82 billion over this time frame. Really a material step up in these 3 years, 35 to 54, 54 to 95, probably as they're making some acquisitions. They took on a lot of debt to retool the business, and that has been extremely profitable for them as they've accelerated their growth rate, the profit margins have gone up and large. So they definitely borrowed here and used that money wisely to grow the business, and we're seeing that bear out now. Excess cash, I'm taking short-term investments line on the balance sheet. That's my measure of excess cash. Excess cash essentially is cash that they don't need to run the day-to-day operation. And if they were to choose to dividend out to the existing shareholders, they could absolutely do it, and the business itself wouldn't be interrupted at all. And when you calculate enterprise value, you want to figure out what the excess cash is and remove that from your enterprise value calculation. So that's here. It's nice to see it stacking up. That means the business is generating so much cash, they don't quite know what to do with it, so it piles on the balance sheet, which is amazing to see. Market cap, that's average shares outstanding times price, $392 billion to $2 trillion market cap as of the last fiscal year, 2021, June. I add up short-term debt, market cap, less the cash, I get enterprise value. Enterprise value is the total value of the business if you were to buy all the stock, lock, stock, and barrel. That's how much it would value at. And incidentally, why you remove the cash is because if you gave Microsoft shareholders a tender offer to buy up all of their shares, they would say, yes, we'll sell it to you, but I want you to take the excess cash, dividend that to me first, then sell the business. That's why you always remove excess cash, because it's not part of the enterprise value. It represents prior period cash generated that wasn't distributed. So investors are going to want that. Enterprise value, $2 trillion, that is an absolute beast. Let's see that on a relative basis. So I like to look at relative to earnings. If I'm buying the business at $236 billion, how much earnings does it generate on an annual basis? And what is that payback period for me? Well, that's 7.2 years prior to the growth spurt that they've had, which is incredibly cheap for such a behemoth of a company. Then as growth is accelerated, as they've become bigger, and their vision has really panned out, the market multiple for the stock has gone up threefold. So every dollar they were paying, every dollar they made back in 2013, investors were paying 7 times for that earnings. Now for every dollar they make, they're paying 25 times for that earnings, which is a much, much stronger premium than they used to get, but probably still a very well-deserved premium at that, given how much top-line revenue and EBITDA has been growing. Kudos to them. But by and large, you can see that this is definitely an outlier at 25 times. Prior to that, the average was 13.6 still, largely dominated by here, and then recently it's gone up. So I think this business definitely does deserve a taller market multiple in this 20 range, because the growth is there, the size and the market dominance is there. They seem to have really figured out where they're going, and that's something you can you don't want to get too cheap when looking for stocks. Sometimes they are well valued, and this is still a value company despite paying a 20-something multiple. Debt is zero because they have so much excess cash they could easily buy out all the debt and make it zero. They just haven't chose to do so. That's zero. So that checks the box for us. Let's go look at free cash flow and see how much cash they yield. Okay, Microsoft's free cash flow statement. I'm pulling this from cash flow statement on the financials, and this is the cash flow from operations, that first third on the cash flow statement. This is the amount of money amount of cash that they generate for selling their software, selling their services, selling the video games. This is everything they do on the P&L, the income statement, that's actual hard cash that we can verify. So they made $28.8 billion in 2013, and that has grown to 32, 29, 33, 39, 43, 52, 60, 76 billion dollars in hard cash that they generated in 1 year of operating their business. That is outstanding. That's a 13% annualized growth rate. That 13% lines up well with our EBITDA, which is on the income statement. So we know the cash flow statement and income statement are growing the same direction, which means the accounting team, good job people, is reflecting what's in the income statement. I like to see that. CapEx is what they have to put back in their business to maintain that ball, to keep it rolling. It's not growth acquisitions. It is building of new buildings. It is new enterprise system. It's laptop computers for people. It's the basics that you need to do to keep the machine running. So last year they made $76 billion. That was sitting in the bank account. Board of directors got together and said, hey, what do you want to do with this? Let's reinvest for the future. Okay, that's the CapEx. Here's $20 billion. What's left? What's left is $56 billion. $56 billion is a lot of jack. That's tremendous. They're like, well, we have a little bit of debt. Let's peel off a little debt. Here's $4 billion, just a drop in the bucket, which is absolutely nothing to them. And then they get $52 billion of enterprise level cash flow. Now, free cash flow to equity is actually what the company's based off, and $52 billion is a tremendous amount of cash. You can see that cash has actually grown over time. Interesting thing here, remember I said earlier that they had zero net debt, right? That they have so much cash, they don't need debt. Well, why are they paying off this debt here? They're making this debt payment. They don't really need to. So this negative is reducing this free cash flow. This cash flow number is actually higher than it should be, or than it's reported. So I would add this negative back in here and just take these two and just use this, what's $56 billion as the enterprise level free cash flow to equity. I do this when I forecast forward. I'll take these numbers and forecast that per share instead of this number, 660, 688, because I think that's a little low, actually. So let me finish. Free cash flow, growing and strong, growing at 8% every year. That's amazing, amazing. Then what do they do with this cash? Well, they're buying back some shares. So they're buying about 1% of the company every year tearing up the company, tearing up the shares. So that means the remaining owners own a greater piece of the pie. You can see there were 8.47 billion shares outstanding. Now there's 7.6. So they've taken almost a full billion in share count out of the market while the enterprise has grown. So that is really accelerating your IRR. Then free cash flow per share, I'm just taking cash flow divided by share. I get this number, strong and growing. Again, I think this is too low. I think given the debt payment's actually higher. Price, average price at the fiscal year, and then a yield. Yield being 2.5 is a lower yield, reflecting the 20 plus higher EBITDA market multiple that they have. And then here, the yield was much higher when they were growing a little less before they really hit this inflection point and started to grow. Average 6.9. So that's the cash flow summary. I would definitely check the box on the free cash flow being strong margins. It's growing. It's very healthy. That definitely checks the box. Okay, let's forecast the business. All right, one thing I liked about Microsoft is we had the economic downturn, the global pandemic, right, last year, and their earnings actually went up. That's fantastic. It's extremely rare, and I like that kind of resiliency. When I think of the business in terms of what they sell, their software, Windows, the Excel version that I'm using here, right? You've got the enterprise software, Dynamics 365. You've got their enterprise that businesses use. How sticky is that? Well, if you're a company and your entire accounting system is running their Dynamics 365 accounting software, you are going to make that payment even when times are down because you need to be able to report numbers to your investors. So you're going to pay Microsoft their license. The same thing for Excel, Word, all the programs that their employees use to run the day-to-day. They have to make that payment. So that is incredibly sticky, even in downturns. And I like a company who sells a product that customers prioritize. They make that the very first payment, right, you make is to the bank. The second one you pay Microsoft to make sure you can keep all your stuff running to operate your business, and I like that. So when we forecast, I wanted to take a look at their growth recently. When I looked at EBITDA growth here, I looked at the last 4 years, including a pandemic, and that is plus 20% growth for the last 4 years. So I'm going to give them that average, 21% year-over-year growth in 2022, and I'm going to bring that down over time because I don't know how long it's going to last, but I'm giving them a very rosy. I think there's a big outlook for what they can do, what they've already done, and I'm willing to bet that the team over there can figure out new opportunities to grow as the business grows. So that's going to take it from $96 billion to $386 billion of EBITDA. Now, if I put that with a market multiple of 21 times, which is less than their current 23 times, right? So they're currently at 23 times. They've been in this 20 range when they are growing at 20%. They're not going back this low because their growth is too high. So I'm keeping them at about 21 times EBITDA, which gives me an $8 trillion enterprise value, which is very, very large. But again, it's ultimately up to their earnings if they can hit the earnings. Less than outstanding cash they have no debt, gives me $8 trillion market cap. Divide by the number of shares outstanding, right? I'm not continuing to remove shares. I'm just keeping the shares flat. Gives me basically a $1,000 price target out long term. That's $1,081 using an EBITDA market multiple approach. Let's go take a look at free cash flow. Free cash flow is relatively the same story. So I'm starting with $7.38. That is the cash flow from operations less capex divided by shares, growing at 20% a year, which is last year, which is our current forecast for this year's growth. So that means $7.38, which was higher than the previous period, right? Because they're not going to make the debt payment. Then I grow that over time and apply a 3.5% yield to it, based a little bit more conservative on the 2.5% that they're currently at, giving a slightly higher yield means a slightly, essentially lower multiple. And I get an $829 value long-term for the stock price in 2031. Okay, so now we have two stock prices based on two different estimate levels. I've got a free cash flow estimate, $829. I have an EBITDA market multiple method, $1,081. I'll split the difference and call it $955 long-term, 10-year out for what Microsoft could be worth and what it does. You can currently buy it at $285 per share. Let's go see what the IRR is. So when I put this into an IRR, I get a stream of cash flow. That's the total cash that they generate. They could choose to dividend it out. They could choose to buy back shares. They could go buy acquisitions, and hopefully they're accretive, and this number would get even bigger. But I'm just taking all the free cash flow, paying it out. I'm taking the change in share over time as the enterprise continues to grow, and I get an 18% IRR long-term annualized rate of return, which is a very strong return in this market, being everything that I'm seeing is very, very well priced. So that is a market-beating return, right? The S&P 500 will do about 10% in any 10-year period of time you choose in its history. So if you're looking at an investment that could possibly yield 18%, that is a market-beating estimate, in my opinion. You have a company with very little debt and very strong upside. I kind of like that. Let's take a look at our 5 key attributes and reassess. Number 1, top line revenue growth, absolutely growing at 10%. EBITDA, yes, it's growing a little higher than that, 12%. Free cash flow, yes, it's strong and growing. Low debt, absolutely it's 0. And well priced, yes, I think it is well priced, if not cheap from a value side, because my return is above market. My risk here, I think, is below market, given that there's no debt on hand and that the revenue and earnings are growing. The product itself is extremely sticky, and customers need to make the payment to Microsoft to keep the business up and running. So I'm going to give this a good. I think it's a good, very good investment, very great investment for someone who's a long-term owner of stocks. So the last thing we do here at the channel is we always look at the distribution for what the stock might return at different prices. So at Microsoft, right now it's $285 per share. I'm getting 18% IRR with these assumptions behind me. If the price should move, this will tell you what you can buy, what you should be able to earn on the stock given these assumptions with a different stock price. So at $285 per share, it's 18% IRR. As the share price goes up, you're paying more for the same assumptions on returns, so your return goes down. If for some reason the stock price should fall, I would absolutely put that on your radar for a buying, because it could get extreme. If it did fall back to closer to 200, it's a 20+% IRR project, which is very rare. And in times of panic of the market and people run, definitely take a look at Microsoft to just go ahead and buy it in your portfolio. Okay. My name is Cameron Stewart. This is Rational Investing. If you want to learn how to do more of this and teach yourself how to become a value investor, how to screen and analyze stocks, I do teach a course. That course is at cashflowinvestingpro.com. You can check it out there. I give you this Excel sheet. I walk you through how to value Apple Corporation, show you the 10Ks and how to read them and populate what is an estimated return for that business. Thank you very much for the time. I really appreciate the comments. Take a look down below. If you haven't subscribed to the channel already, please hit that subscribe button. I really appreciate that. And then like the video if you like it. Let me know what else you'd like to see. My name is Cameron Stewart from Rational Investing. Thank you very much. Bye-bye.